Welcome to Talk Tickers, where we cut through the noise of earnings calls to give you the most important insights. Today, we're diving deep into the latest results from Fabrinet, ticker FN. They're a key player in optical communications and, advanced electronics manufacturing.
Yeah, this quarter, it delivered some really compelling numbers for Fabrinet, beat expectations pretty much across the board. But here's where it gets interesting. The market's initial reaction, it told a much more nuanced story, almost a sell the news kind of moment.
Right.
So we're going to try and unpack why that divergence happened and what it might mean for you, our listener, trying to make sense of it all.
Okay, let's jump straight into those headlines then. Fabrinet's fourth quarter of fiscal year 2025, it wrapped up on June 27th. They reported revenue of $909.7 million, comfortably beating the consensus estimate, which was around $882 million. That's a strong 20.8% increase year over year.
A new quarterly record for them, actually.
Exactly, a record.
And on the profitability side, the bottom line, non-GAAP EPS hit an all-time high too, $2.65. Just edged out the $2.63 set consensus. And for the full fiscal year 2025, record revenue again, $3.4 billion. It's a robust 19% increase. And full year non-GAAP EPS reached $10.17.
Just quickly, non-GAAP, that's basically earnings adjusted to take out some one-off items, right?
Yep.
Gives a cleaner operational picture.
Precisely. It strips out things like stock-based compensation or certain acquisition costs to show the core business performance.
Okay. So on paper, it looks like a near-perfect report.
Yeah, I think so.
Yet, like you said, despite these strong beats, management sounded pretty upbeat, but the market had that immediate sell the news reaction after hours. The stock took a pretty significant hit.
It's a bit of a paradox, isn't it?
It really is. So we'll dig into why that might be in just a moment. But first, let's peel back the layers, go deeper into those numbers and what management was saying. So unpacking that record revenue, $910 million, not just up 21% year over year, but also 4% sequential growth from Q3. That definitely shows some accelerating momentum, doesn't it?
Absolutely. And that strength at the top line, it translated down to the margins, too. Non-GAAP gross margin came in solid, 12.5%. And the non-GAAP operating margin, that actually improved by 50 basis points sequentially, got up to 10.7%.
50 basis points, so 0.5% improvement in operating efficiency. A nice little step up.
Yeah, every bit helps.
Now, while the profit side looked strong, the cash flow story was, a bit different this quarter. Operating cash flow was $55 million. But capital expenditures, CapEx, saw a really big increase, up to $50 million.
Right.
Mostly for that ongoing construction, Building 10, they call it, and ramping up new programs.
Yeah.
So that brought free cash flow way down to just $4.7 million for the quarter. But this was intentional spending, wasn't it? Aimed at future high-margin stuff.
Exactly. You've got to see that FCF dip as a strategic investment, not really a weakness. They're spending now to build out capacity for growth later. And despite that spend, they still ended the year with a very strong balance sheet, $934 million in cash and short-term investments.
That's a good cushion.
It is. And they also returned a record amount to shareholders through buybacks in fiscal 25. $126 million. That's the most they've ever spent in 1 year.
Wow.
$22 million of that was just in Q4. And they still have authorization for another $174 million in future buybacks. So they're committed to shareholder returns.
Okay. Now, customer concentration, that's always a thing with Fabrinet, right?
It is, yeah.
NVIDIA accounted for 28% of total revenue in FY25. Cisco was 18%. And the top 10 customers together, a huge 86% of total revenue.
Yeah, significant concentration, but it's pretty consistent for them.
Right.
It reflects their focus on these really large-scale, high-complexity projects with major players.
Makes sense. Okay, let's look at the revenue categories. Optical communications was strong, $689 million, up 15% year over year.
Right. And within that, telecom revenue really jumped $412 million. That's up an impressive 46% year over year.
Yeah.
And a lot of that was driven by data center interconnect, DCI products.
And that's interesting because Fabrinet reported DCI as its own separate category for the first time, right?
They did, yeah.
Came in at $107 million in Q4. That's 12% of overall revenue already. And it grew 45% year over year.
It gives much clearer insight into what's obviously a huge growth area for them. It's pivotal.
Definitely.
Okay, then there's datacom revenue, $277 million. Now, that was actually down year over year.
Okay.
But it showed strong sequential growth, up 10% from Q3. And that was driven by demand for the new higher data rate products, especially these 1.6 terabit transceivers. They've just started volume shipments of those.
1.6 terabits per second? That's just a mind-boggling amount of data, crucial for AI and cloud data centers, I guess.
Absolutely critical. And products running at 800 gigabit and faster, that bucket was $313 million, up 32% sequentially. Mostly these new 1.6T products. In contrast, stuff below 800 gigs saw a sequential decline. You can really see the industry shifting to higher speeds.
Yeah, it sounds like they're right at the front edge of that tech shift. What about beyond optical, non-optical communications?
That also showed healthy growth. $221 million, up 41% year over year. Within that, automotive was strong at $128 million. Industrial laser was stable, $40 million. And the other revenue bucket, $53 million. That was helped because a non-cash contra revenue item from the prior quarter didn't repeat.
Okay, so good diversified strength there too.
Definitely. And the CEO, Seamus Grady, he sounded really positive, called the quarter excellent and the year outstanding. He kept emphasizing the record quarterly revenue, the all-time high non-GAAP EPS, talked about having tremendous momentum going into fiscal 26.
Did he really?
Yeah, he even expressed confidence they could hit $1 billion in quarterly revenue, pointed to multiple growth drivers to get them there.
Okay, so what are those drivers for FY26?
Well, they outlined a few key things. A new telecom system launch, continued growth in DCI, obviously increasing demand for those 1.6T transceivers we talked about, and the ramp up of a big high-performance compute, or HPC program.
Ah, HPC. That includes the Amazon Web Services partnership, right? That sounds like a big deal.
It really is.
Yeah.
A very big deal. In fact, Fabrinet is going to start reporting HPC as a new separate revenue category starting next quarter, Q1 FY26. They had some initial small shipments in Q4, but this signals a major expansion into a whole new market, a new TAM for them. They're actively looking beyond just AWS now, too.
Wow. So they're not resting on their laurels.
Not at all.
So to handle all this demand, telecom, datacom, HPC, they're thinking about speeding up construction on part of Building 10, getting it done maybe 3 to 6 months early.
Exactly. They're evaluating options to accelerate it. It's a serious commitment, even if it means higher CapEx temporarily.
I mean, literally building faster to keep up with demand. That says a lot about their confidence in future growth, doesn't it?
Absolutely does. Strong signal. But there was a key near-term challenge that came up, and this probably contributed to that market reaction we saw.
Okay, what was that?
Temporary component supply constraints, specifically for datacom products. They're having trouble getting enough of these 200 gig per lane EML-based components. Yeah, electronic modulated lasers. They're specialized, really crucial for the highest speed stuff, the 800 gig and 1.6T transceivers, the backbone of next-gen data centers. And these shortages are expected to cause a sequential dip in datacom revenue in Q1.
Okay, a dip in Q1. But management thinks these issues are short-lived, like resolved in 1 or 2 quarters.
That's what they said, yeah. They anticipate resolution within 1 to 2 quarters.
But I mean, in your experience, how often do temporary supply chain problems, especially for critical components like that, actually clear up that fast? What's the risk if they linger?
Well, that's the million-dollar question, isn't it? Management did stress the demand is currently way higher than supply, and they sounded, pretty confident about a quick fix. But supply chain stuff can be sticky sometimes. The biggest risk, if these temporary issues drag on past Q2, that could hurt their ability to capture all that demand for the high-speed products. Maybe even let competitors grab some share if they have better component access. It's definitely something investors will be watching like hawks.
Yeah, you bet. Okay, so guidance for Q1 fiscal 26. Revenue between $910 million and $950 million. Non-GAAP EPS between $2.75 and $2.90.
Right. And they also flagged some seasonal margin pressure, maybe 10 to 20 basis points. That's from annual pay raises and some temporary inefficiencies as they ramp up these new products. But that usually recovers over the year.
And some reporting changes, too. No more revenue by data rate or silicon photonics breakout.
Yeah, they're discontinuing those. Most of the silicon photonics stuff is now under DCI anyway, or just being overtaken by the newer, faster rates. It kind of reflects how fast the industry is moving.
Makes sense. Did analysts push back on any of this?
Oh, yeah. They definitely probed. On the HPC segment, management made it clear it's a totally new, distinct category, not just part of datacom. That's important for understanding the Q1 guide and seeing these growth drivers separately. They also talked about 1.6T versus 800 gig for hyperscalers. Their main customers moving heavily to 1.6T, but they see a long runway still for 800 gig in the broader market. Fabrinet says they're chasing like 4 distinct growth areas in datacom overall.
Okay. What about margins and operating expenses?
The CFO said they aim to keep gross margins in the mid-12% range, even with that temporary pressure from new ramps and pay rises. And they're staying really disciplined on operating expenses, OpEx, keeping it below 2% of revenue. That's how they drive operating leverage as the top line grows. It shows good operational control.
And when pushed on those supply constraints,
They basically reiterated it's a handful of components, affecting both 800 gig and 1.6T for their main customer. It's causing a substantial enough headwind for Q1 that they had to call it out specifically.
but still sticking to the short-lived problem line.
Yep. 1 and 2 quarters for resolution. And stressed again that the good news is demand is outstripping supply. So it's a supply issue, not a demand issue, which is better, relatively speaking.
Right.
And finally, the DCI business just keeps showing strong, durable growth, clearly riding the wave of big data center buildouts and AI workloads. They also confirmed no big hit from tariffs so far. Shipping terms often mean the customer pays, and a lot of the product destinations are outside the U.S. anyway.
Okay, so stepping back, this earnings report really highlights Fabrinet's strategic shift, doesn't it, towards these high-complexity optical and data center programs.
Absolutely. They are clearly benefiting from the whole AI and data center build-out trend. They've positioned themselves really well with key hyperscaler partners like AWS, and they're ramping up these next-gen 1.6T products. And in fact, they navigated a huge product transition with a major datacom customer while still growing so much in fiscal 25. That really shows their operational strength, I think.
So back to that constructive print, cautious tape idea. Great results, optimistic management, but the stock sold off.
Yeah.
It seems like the market just focused on the negatives, maybe high valuation already, then worries about free cash flow because of CapEx and those temporary supply issues. It just outweighed the good news for the moment.
I think that's right. And the stock had run up quite a bit going into the print, too. So maybe some of that good news was just already priced in.
Yeah.
Classic sell the news.
Yeah, makes sense.
But the company's disciplined cost control, their focus on high margin programs, those are definitely critical strengths. For you, the investor, the key thing to watch now is how fast they actually resolve those supply chain issues and how quickly the GAAP earnings and free cash flow conversion improves as these new high-value programs really start to scale up. That new HPC revenue category should give us much better transparency into that big growth area, too.
All right, now for the part of the deep dive our listeners sometimes look forward to, some actionable, maybe slightly speculative ideas based on this call. And remember, everyone, this is absolutely not financial advice. These are just concepts for discussion. Investing always involves risk. Your capital is at risk. Do your own homework.
Okay, disclaimer delivered. So given Fabrinet's strong underlying results, but that immediate risk-off market reaction, yeah, there's an interesting setup here. It might appeal to the, let's say, truly bold investor.
Okay, I'm intrigued. Let's hear it.
Well, let's call this one the Building 10 Blitzkrieg bet.
The Blitzkrieg bet, okay.
Think about it. Management is accelerating construction of Building 10. It's a massive capital expenditure, right, for a future payoff. They're pouring money into capacity because they expect booming demand. From HPC, from 1.6T.
Right, they see the wave coming.
Exactly. The market just saw the near-term dip in free cash flow and maybe freaked out a bit, hit the sell button. But what if this huge investment pays off much, much sooner and bigger than even management is publicly projecting? What if it just blows away expectations in, say, 2 or 3 quarters?
So you're thinking the market is totally misjudging the impact of this accelerated build-out?
Potentially, yes.
Yeah.
This is where it gets a little wild. You could think about a deeply out-of-the-money, long-dated call option strategy.
Okay, define deeply and long-dated.
I mean, think calls maybe expiring 6, maybe even 9 months out, way beyond where most analysts are focused right now, and targeting a strike price that assumes a truly explosive, almost unbelievable ramp in revenue and free cash flow. Once in 10 there. Building 10 is fully online, and those temporary supply issues are long gone.
So your betting management's tremendous momentum comment was actually a massive understatement.
Essentially, yes. You're betting the market has massively underestimated the strategic importance and the speed of the payoff from accelerating this capacity build. It's high risk, no doubt. Those options could easily expire worthless.
For sure.
But it's a potential high reward play if you genuinely believe the market has completely missed the long-term story buried under the near-term CapEx and supply headlines.
The Building 10 Blitzkrieg bet. Okay, definitely outrageous, but I see the logic based on management's actions. So let's summarize then. Fabrinet delivered truly strong Q4 and full fiscal year 2025 results. beat expectations across the board.
Yep.
Driven largely by that robust demand in optical comms, DCI, and the early ramp of 1.6T products in these new HPC programs, especially with AWS. And management sounds undeniably optimistic about FY26, accelerating capacity expansion plans.
But the immediate market reaction was, well, negative, clearly driven by those near-term worries. The temporary component supply constraints hitting Q1 datacom revenue and the higher CapEx affecting free cash flow right now. That was despite management sounding pretty confident they'll resolve these things quickly. The long-term story, though, that strategic shift towards high-complexity, high-value programs, that seems totally intact. Positions them really well for the whole AI and data center build-out cycle.
Okay. And as always, just to reiterate, the content discussed here is purely for informational purposes. It is not financial advice. Investing involves significant risks. Always talk to a qualified financial professional before making any decisions. Your capital is definitely at risk.
We really appreciate you tuning in to Talk Tickers. Fabrinet navigated a complex quarter, strong results underneath, but that market reaction certainly opens up questions. The real deep dive now for you listening is maybe to think about this. Are these near-term headwinds, the supply issues, the CapEx, are they truly just temporary blips on a long-term growth path fueled by AI and data centers? Or do they maybe signal something more structural that needs a closer look? Definitely something to chew on.